you want investing to get easier? Here's a dirty little secret. It won't. It's not going to get easier. Investing is a game that's played between the ears. You got to know enough about what you're investing in, but you also got to have the discipline and the mental fortitude to persevere through all different types of market conditions on your way to success. And so it's so critical for you to be able to have that kind of mental framework no matter what the markets are doing. You know, you have occasional markets where it's a little bit easier. You have just a nice, smooth, gliding market that goes higher, right? It's somewhat close to the normal averages that you expect in whatever investment that you're buying into. Okay, but generally speaking, it's not happening like that. It's either going like this or it's going like this, right? And this, like we've had over the last couple of years, well, this can feel great, but it also could start making you feel like, oh my gosh, if I'm only going like this, and I'm seeing the markets going like this, then I got to go faster. I got to buy more. I got to get more aggressive. I got to take on more risk. It's like go, 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 because you know there's no drawback, right? I mean, the markets are just going up, smooth, 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 until the last couple of weeks. Now all of a sudden we're starting to see things going the other way. So if you get sucked into this, it makes this even more steep. So you have to play that game. You got to make sure that you're mentally fine, that you know the strategy that you can actually handle and you can live with. Because if you're trying to just have a nice glide higher, and then you start getting yourself into this mode where you're seeing stuff happening like this, and you start going like this much more, right? You're going up too hard and then down, and so if you can easily get off kilter either way. Right. And so now we're in a moment where people are getting all this FOMO. I want to go faster, faster, faster. You get the volatility, and now people are kind of concerned what's happening. And we have so much news flow, so much information that's passing past our brain all the time. And it's telling us that, like, oh my gosh, the markets are either going to go to the moon or the markets are going to crater, leave a big hole in your portfolio. So you're constantly getting messages of either, oh my gosh, fear, greed, fear, greed, fear, greed, fear, greed. Yes, these things are as old as time, but you have to be able to battle through all of those different emotions to be a successful investor. So what I would say is, yes, you got to focus on understanding what's happening in the news. Pay enough attention to what's happening in the news so that you're informed and that you have some sort of understanding and some sort of context for all the events that are happening in the world and that could affect markets. At the same time, don't get yourself so consumed that you become reactionary where you're twitchy and you want to buy, sell, buy, sell, buy, sell as you're watching the markets go like this, right? That's number one. And number two, don't you get yourself in a place where you're getting mentally exhausted and you're getting all whipped into circles and you're not sure what to make of anything or where you should position your money. The most important thing you want to think about is internally, Forget about what's happening externally. You can't really control much of that. You got to understand it, but you want to focus internally. What are my goals? What's the timeline for my goals? And how close am I financially to those goals? If I got a goal, I need $2 million to retire and I'm at 1.9 million, I'm pretty close, right? What's my timeline? Am I a year away from that, 2 years away from that, 3 years away from that? If I'm wanting to retire in 5 years, I'm really, really close. I've got plenty of time. I need to maybe dial back my risk a little bit more. If I'm a year or two out, same thing. It's like you want to make sure that you don't fall from 1.9 down to 1.2, 1.3. Who knows where these markets are heading? The point here is that as you get closer to a goal, both in time and in dollar value, you want to think more about those downside risks so that you can achieve that goal, right? No one says I want to retire at 60 and then it's like, oh, well, I'll just delay it till 65 and still feel fine. No, when they get their mind made up that they want to retire at 60, they want to retire at 60 and they've already started thinking about what they want to do at 61, 62, 63, 64, 65. And so the best way to protect yourself is to make sure that your portfolio is in alignment with your life and your life's goals. And whether that's retirement or a college education for a child, or you have a home purchase you want to make and you need the money for that down payment, you want to start a new business, start a new career, all kinds of different goals. Understand your timeline, understand how close you are financially to achieving those goals. The closer you are in both those things, the more you want to think about the downside risks. The further away you are, the more you can just kind of ride with things a little bit better. Just keep pounding money into the markets. It's not as crucial a factor at that point. Just like flying an airplane. At cruising altitude for most of the journey, as you're getting close, you got to start thinking about how you're going to land the plane. Same thing here with your financial goals.